For those of you who have joined, we're just going to wait a few minutes for some other people to have a chance to join in, but welcome. We have people still coming in, so we're going to just wait a few more minutes. Welcome, Ashley and Todd. For those of you coming in, welcome to today's very exciting webinar event. We're just going to wait a few more minutes to give people a chance to log in before we get started. I see people still actively coming in, so we're going to just wait a couple of minutes more. Okay, so I would like to welcome everybody. There's going to be a few more people coming in, but they'll join after we start. But I would like to welcome everybody to today's next webinar as part of our ongoing webinar series. We have with us today Carl Grant, and I'd like to introduce Carl. First, before we do, just a little bit about Next. Next, powered by Schulman Rogers, is an innovative new model for delivering legal services from launch through each stage of growth, and has really been designed from an entrepreneur's perspective. Next offers predictable and reasonable legal fees by productizing a broad range of legal services into fixed price packages. Our clients work directly with seasoned attorneys through a very hands-on legal services model, and we integrate technology to create a very client-centric experience that is collaborative, efficient, and transparent. And for more information, you can visit us at www.next.law. So as I said before, we are really honored today to have Carl Grant with us. Carl is the CEO of Capital Raise, which provides a SaaS-enabled service that helps growth stage companies raise capital and obtain liquidity events. He also leads Connexa Partners, which provides outsourced business development and training for professional services firms. Carl is a published author and was the first business development leader hired by PricewaterhouseCoopers and was global head of business development for Cooley for 20 years. Carl was on the management team of 2 venture-backed companies and is a private pilot. He studied venture capital and private equity at the Harvard Business School and has an MBA from Kelley School of Business at Indiana. So with that, Carl, I'll hand it over to you. And again, thank you so much for joining us today.
Thanks, Anthony. Appreciate it. So today we're going to be talking about equity basics for entrepreneurs, and I stress basics because we're going to be talking really fundamental stuff here. Some of you may know all of this, but I bet you'll pick up a few tidbits that maybe you hadn't thought about. And so we're going to go through the following. I'll get this to advance slides. Huh. My slides are frozen there, Anthony. Give me a second here to get these working, and then we will proceed. We will have an opportunity for Q&A at the end, and so let's get this back up here.
Carl, while that's coming back up, somebody just asked a question if they'll get a copy of the deck at the end.
I'll share it with you, and you can share it. So
Okay,
I will try to do this again the proper way, but if it doesn't work, we'll just have to keep it here. So this is the overview. We're going to talk about developing a business model. Now, all of you have developed business models. Some of you may have done it right or not done it right, and we'll talk about some of the things that you'll want to see here. The types of capital that you can access at the various stages of growth for your business. Here we go. I'm just going to drive on here with the slides the way they are, so we don't take up too much time. So, how much to raise and when? I'm going to give you some tidbits there. The amount of dilution you can expect to see over rounds, and then what every entrepreneur is interested in is that the exit economics. So, in building a financial model, interestingly enough, this is the one slide that entrepreneurs leave out of their deck time and time again, and it drives me crazy because I behave very much like a venture capitalist does when they look at a deck. There's actually a study done about 7 years ago that was published in TechCrunch, and I always send it along to an entrepreneur when we're about to work together. And what they did was they studied the habits of VCs when the VC would get a deck. I think it was done through Pitchly, if I'm not mistaken, and they would look at the order the slides were that the VC looked at and how much time they spent on each slide. And interestingly enough, the majority of VCs go to the financial slide first and spend the most time on it. Yet entrepreneurs will leave it out of their deck often. And so knowing that, and the reason is because think about it, they're in the finance business. The financial slide, that's speaking in the language that they speak in, right? Some of you may have done a class in love languages. People receive love and express love in different ways. And in the business world, you have people who are qualitative and people who are quantitative. VCs are quantitative. And so while they don't believe your financial projections, they want to see how you're thinking as an entrepreneur when you lay them out. And a lot can be derived from what you put in your financial projections. So there's a pattern that I've seen time and time again in the companies that have raised money successfully, and that is a pattern of you don't want to do this exact. You don't want to go like 10 million, 20 million, 40 million, but there's a pattern where there's somewhat of a doubling of revenue year over year. And then that 50 million number, it was actually a number that I got many years ago from a VC. I showed it was a female VC. I showed her an executive summary that had projections out to, I don't know, 30 some million in revenue. And she said, Carl, if they can't show us a pathway to 50 million in revenue in 5 years, we're not interested. So that's not every VC out there, but it was a very important one, to say the least. And so since that was the number she gave me, I've noticed that most of the decks and executive summaries I've seen that have been successful hit that neighborhood, right? And so it could be 40, it could be 60. I wouldn't exceed 100 million in 5 years because it's just kind of pie in the sky. No, very few people hit that number. Shooting to be around 50 in year 5 is a good goal. Now you may be wondering, how do I get there? We've got 50K in revenue, and how in the world am I going to get to 50 million in revenue? Well, you get there by making some assumptions, and you have to build those into your financial model. And I know this is hard for some people to think beyond like this quarter or next quarter, but you have to do this. You have to assume that you're going to raise whatever, if you're raising a seed round, assume that round into your projections. So if you raise $500,000 or $1 million, what are you going to do with that money? You're going to hire sales and marketing people? Is that going to help you expedite revenues? And so you're going to assume in at least an A and perhaps a B round in your financials. And then what are you going to do with that capital? If you raise $5 million, you can hire a lot of salespeople for $5 million and you can really blow out your business. And so, don't be afraid to do this, because if you don't raise those rounds of capital, all those assumptions go out the window, right? And so this is part of that model that they're looking at, is how are you thinking as an entrepreneur? Are you thinking like a venture-backed entrepreneur? Are you thinking like a lifestyle business? And so if you're projecting 9 million in year 5, that's a lifestyle business in their eyes, right? But if you're projecting 50 or 60 million in year 5, that's a venture backable business that could get a nice exit. And so when you present your financials initially, you got to have all the data to back up what you're doing, but don't put it on your initial deck. Only put the revenue line and the EBITDA line. The devil's in the details. There'll be plenty of time if they're interested to go and ask you for the details. They just want a teaser initially, and those can be actual numbers, or they can be a line chart or a bar chart, however you want to present that. So when we talk about the types of capital you can raise at various stages, a lot of this is probably familiar to a lot of you, but let's talk about the first one, because this is the one that a lot of entrepreneurs miss, kind of like that financial slide. Non-dilutive financing is key, right? Especially, so if you're a life sciences company, non-dilutive financing comes in the forms of grants. I'm on the board of a life sciences company, and we put in the friends and family money. We passed the hat around the board, and we each put in money according to our ability. And now we've used that money to hire a grant writer who's writing grants for us to get that kind of funding. We're going to do that before we go out to angels or VCs. For a software company, that's going to look different, right? And so most software companies are solving a problem that another company is experiencing. And so you want to think about, whose pain point are you solving? And is it worth it to that company for them to pay you to solve their pain? And so the companies that have done this successfully, what they do is they go into the ideal customer and they say, look, we're going to develop a solution for you. And you discount that solution for them, but you retain the rights to resell that solution to other customers, right? And so since you've cut a sweetheart deal for that first customer, you get them to pay you to do it, and that's essentially your angel money. And it's non-dilutive, which is the best, right? You're not giving up equity. When you think about it, a company at its very early stage, say you're pre-revenue and you've got an idea, well, that is the worst time to raise equity financing in the company's history, because the value is the lowest and you have to give up the most. Even if you do it on a convertible note type of instrument, you're still setting a cap, and that cap is a valuation, right? And I did that with my company. We had to raise a little bit of money. We raised, it was kind of friends and family money. They were partners at venture funds, but they were friends of mine. And we raised it, but we had a cap. We had a low cap to entice them to come in. And it was expensive. So we raised $150,000. I say friends and family because those are the folks that are most likely to write you a check quicker. My experience over 25 years of doing this stuff is that your typical, super angel will get to know you for 6 months before they write a check. They won't tell you that, but they'll tell me that. They'll say, I want to watch that entrepreneur for 6 months before I write a check. That's a big time waste for entrepreneurs, and they will send you back to do homework assignments and take up your time. And I don't like doing angel raises for entrepreneurs because it takes a lot of work and it takes a lot of time. And so I encourage folks to go to friends and family. What I would do when you approach friends and family, rather than sending an email saying, I want you to invest in my company, that's a good way to have your friends and family avoid you when you do that. What you do is you ask them for advice. Everybody's willing to give advice. And I'm telling you what I did, right? I have a rich uncle. He may see this video. I sincerely, Uncle Hank, wanted your advice, you know, but I know that he's been a successful CEO, and that if he liked what I was presenting to him, he could invest if he wanted to. But I sat down, had coffee with him, and got really good advice. And so if you do that, what you'll find is that if you ask advice is who do you think I ought to approach for funding at this stage, they may come up with a list of folks, and they may say, I'm in for 25 or 50 if you get so and so in. So, when you get those friends and family, the way you make that round go further is when they commit, get their money as soon as you can, because money has a way of getting wings and flying away. So capture it as quick as you can, but ask them who they know who might also be interested in this round. And then you can multiply that 100K to 200 or 300K. Certainly angels are the next one when you're early stage. When I say early stage, I'm talking kind of pre-million in ARR, annual recurring revenue. Most VCs, they'll tell you that they go pre-revenue or early, and some of them do, but very few. I as somebody who's raised seed capital myself and has helped many companies do it, friends and family are the best source before VCs. And then, when you go to VCs, the key here is you got to go through somebody they know. So Anthony's got some venture capital contacts. The next program does. Certainly lean on your service providers. Think of them as partners, not vendors. And I've worked for a couple service providers myself, and I routinely did venture capital referrals as part of the value add of those engagements. And so think about who you align yourself with. Ask them who's in their network. Ask them if they're willing to make referrals. And if they're not willing to roll up their sleeves and help you at those early stages, maybe you need to find different service providers. I want to go through like who VCs get their referrals from. I actually did marketing research on this in the early part of my career. They like to get deals from limited partner investors. Those are the folks who invest in their funds. They like to get referrals from portfolio company CEOs that they've backed, from law firms that they work with, accounting firms they work with, and banks. And so at the early stage, it would be like a Silicon Valley bank. At the later stages, it would actually be an investment bank. And so once you move beyond the VCs, you go to strategic investors. Strategic investors don't typically lead rounds. They typically will participate in a round with a venture capitalist. The one warning I would have about strategic investors is think about whose money you're taking. So if your most likely exit is a competitor to that strategic investor, you might want to avoid taking that strategic investor's money. It could muddy up the exit. So just think smartly about who you're taking the money from. Growth equity investors really sit between VCs and private equity. So when we get down to private equity typically comes in at about 10 million in revenue, whereas growth equity investors, some of them come in at 3 million in revenue, some of them come in at 5 million in revenue. So I love when a company gets to 5 million in revenue, especially if they're bootstrapped, because the world of investors you can target at that stage is vast, and the deal terms are pretty sweet. They even come in and allow you to take chips off the table. If you've been running the company for several years and you want to take $1 million out of a round, I've seen that done. I've actually seen some pretty good outcomes on those growth equity deals. I can talk to you offline if you want. Family offices are a more elusive group of investors. Certainly, I know organizations that target family offices. They charge a hefty fee for doing that, and most of those organizations have more of a spray and pray mentality. So if you're going to target family offices, get with somebody who knows them. I know some of them. I don't know the vast numbers of them. My son actually worked for a group called Family Office Networks in college and has a lot of knowledge in that space. He's working with me in my current company. Private equity, that's later stage, 10 million or more in revenue. It can be a way of getting liquidity event or growth equity. And we are affiliated with a broker dealer that does those deals as well. So when we're looking at stages and sources of financing, I I did go to Harvard Business School for an executive ed course right before COVID, and you'll see some slides in here from Harvard. I think they're pretty helpful. So at the seed stage, here they call it idea stage. We've all seen accelerators in the market. Some of those accelerators come with capital, which is helpful, and you surround yourself with smart people, and you get some money out of the deal. We've talked about angels. Crowdfunding sites can work. I've seen them work, but I would say if you're going out to raise venture capital and you have a crowdfunding campaign going concurrently, sometimes that can taint you in the market a little bit. So think about how it's going to be received when you raise that kind of money. All right. Scout VC funds. So some of the very big funds are really too big to do a seed deal, but they know that every company starts as an idea, and every company starts as an early stage company. Yet they're not set up. When you've got $1 billion fund, you can't be doing 500K investments very effectively, and so they will sometimes put some money into a scout fund who will find those deals for them and invest in them early on, and then they've got a pipeline of deals as they mature. We talked about seed venture capital funds. Be leery of ones that say they do pre-revenue. I see very few of those deals get done. Most of these seed stage deals are safe notes and convertible notes. Anthony and his team are very good at doing these. I would say, if you're raising a significant amount of capital and you've got, institutions involved, you definitely want to get a good law firm involved. For the seed investment that I did, I pulled a Y Combinator note off the internet and did it. Probably not what Anthony wants to hear, but that can work too. But I would say if you're raising a real round, mine was my developers and two friends, and we did it on the Y Combinator note. I'm actually talking to a search fund right now because I'm advising a company who's trying to get acquired. And one of the acquirers is a CEO who's funded by a search fund to acquire a company that this guy would come and run. And so, sometimes they'll go early idea stage, but in this case, they were really looking for a company with 10 million in revenue. And so that's a search fund. At the early stages, certainly when VCs do a deal, it is most typically preferred stock. Anthony can walk you through what that looks like. You will typically lever that investment with some venture debt to make that equity go further. And if you raise a $5 million round, you could typically go and get a $3 million line of venture debt to make that $5 million go to $8 million without taking the extra dilution. Receivables financing is something that's available to you when you have significant revenue, and it may seem expensive because it's got a hefty interest rate on it, but when you think of the whole scheme of things, it's really not as expensive as giving up equity. And so I would look hard at receivables financing if you've got the revenue to support it, because you can get that capital in and grow faster at the earlier stages without taking the dilution when it's expensive. And if you can get customer financing, by all means, look at that. When you go to later stage up to exit, a lot of this we've already talked about. I have seen some of these organizations that call themselves asset managers, which is perplexing to me. So you sometimes see that there. I've seen very few hedge funds in my time. Certainly lots of venture debt and corporate and strategic investors. IPO is a great way of raising financing, but typically you're much further along. I mean, for a proper IPO, you're typically, as a software company, at about 100 million in revenue. For life sciences companies, it's a whole different story. Acquisitions, an exit event for most entrepreneurs, sometimes they'll stay on, but usually that's a phase out for an entrepreneur. And securitization is not something I've dealt with in my career. All right, so this slide, how much to raise and when? Well, of course it depends, right? Because every company's different, and when a lot of what I'm going to talk about here is for your typical technology company. Life sciences companies are much different, and the capitalization is different. But when you're going out to raise a seed round, when I put 500K down, I put that down because sometimes I see entrepreneurs come out and they're raising a $7 million seed round and they're targeting angels. Well, For your typical angel that's good for, 50 or 100K, a $7 million seed round is going to scare that person away. I mean, they're going to say, I'll get lost in that round. I won't be a meaningful part of that round. And so I would say when you're going out to target angels, a good number to start with is 500K. The reason I say that is because, you know, if I had 50K to invest, I would go into a $500,000 round. And just because you say you're raising $500,000 doesn't mean that's the amount that you have to raise. I've seen many company fall short of the 500,000. I've seen some blow past it and extend it and raise more money off of that $500,000 initial ask. Yeah, yes, you will always need more than you think, right? So if you say, well, I only need $175,000 to get to the Series A, there's always unforeseen circumstances that you will want to be able to cover. So raise a little bit more than you think you need. And when I say don't ask for too much too early in the 1/3 rule, this is something that may not be intuitive to a lot of entrepreneurs. And I see this a lot, right? So if you're going out for a $25 million Series A round, you're signaling to the market that you have an anticipated valuation without even realizing you're doing it. And so I've had VCs come back for a scenario like that where they say it's overvalued or the valuation's too high. And the entrepreneur will say to me, well, how do they know that? We didn't talk about valuation. And what I tell them is they're doing the math, right? If your typical Series A investor wants to take about 1/3 of your company, and typically they come in for 20 to 40% of your company at the Series A, and you're asking for $25 million, you're signaling to the venture community that you think you're worth roughly $75 million. It won't be exactly $75 million, but that's what I do. When I look at a valuation, I always just multiply it by 3, and I figure that's what the entrepreneur thinks they're worth, and that's what a lot of VCs do, right? They're not going to overly analyze this. They're going to look at it and they're going to make that guess. And so, if you're a software company with $1 million in annually recurring revenue, and you're raising money, and you're not sure if you're going to be able to command a single digit or a double digit valuation, being that under 10 or over 10, you can hedge when you do your ask. And so what I've advised a number of entrepreneurs to do over the years is raise 3 to 5 million, right? That way you're not telling the venture community that you're necessarily worth 15 million or 20 million, but they could get there if they want to put more money to work, and that happens often. And if they don't think you're quite worth, that valuation, they could come in and they can do a sub $10 million, especially in a market like we're in now, offer on the valuation, and maybe it'll work. So just some things to think about that you might not have thought about. So the next slide kind of makes me laugh because I had to go to all the way to Harvard to get these simple principles, right? Yeah, these are like no-brainers, right? You always prefer more cash than less. Sooner is better than later. The third bullet point is the one I like the most. That is, the cash from customers is better than cash from investors, right? Remember the whole non-dilutive capital discussion earlier? If you can get it from customers, one, you're going to be more fundable in the future, and you're going to be less diluted, and you're going to be happier in the long run. All right. And the last bullet is of course, don't run out of cash. And I'm going to reference a client I took on early on. The company was doing phenomenally well. The revenues were growing so fast, and I should have thought to ask the question, and shame on me for not doing it, but they were not profitable on those sales. And while the sales looked fantastic and the investors were interested, the company only had like 5 or 6 weeks of cash left, and they were burning it with every bit of revenue they brought in. And so when the VCs started to bite, at like week 5, which is typical in a raise like this because it takes time to get stuff scheduled, they were shutting down the business. And I'm like, what? I would have never taken you on if I knew that you had that little cash. And so that because it takes typically 3 months in a good economic climate to raise capital. And in a bad economic climate, which is where we are and where we're going, I've had companies take as long as 6 months or more if the VCs are getting cold feet or nursing their wounded and so forth. This is a slide I like a lot, from somebody over at the Founders Institute. When you start a company, you own 100% of that company. And if it's just an idea, you may think your idea is worth a lot, but it's really not worth anything at that stage, right? So you own 100% of nothing. If you team up with a founder, say you're a business founder and you team up with a tech, this is what I did. I teamed up with a tech partner who Anthony knows, and we did essentially this. It wasn't 50-50, it was 40-40 because we left 20% outstanding for either an option pool or for to be able to issue equity if we needed to for investors. And so we split it up. I did the business side, they did the technology side, and we have a more valuable company. We went and we tried the rich uncle, that didn't work, but in this case, they did take money from the rich uncle, and he put in an investment for 5% of the company, and you'll see that the founders got diluted down to 37.5%. They did issue an option pool of 20%, and the goal for an option pool is 10 to 20%, and you'll see what happens with that 20%. 20% was a good number because that number will get diluted over time. And so as you move along, you take the angel money. The angel money comes in. In this case, it was a priced round, and they bought stock, and they got 16.7% of the company, and you see the squeeze on the others, right? Everybody got squeezed a little bit, but the company's more valuable now because you have more capital and you can do more. The next scenario is exactly what I told you. Those VCs like a third of the company, and in this case, it's exactly a third of the company, 33.3%, and then the original founders down to 19.2%. But that's okay because in the next scenario, which is highly unlikely and unusual, but in this case, they went public after just a Series A round, and they sold 8.3% of the company. Hopefully, they got a $1 billion valuation on the public markets, and the founder, who now has 17.6% of the company, is happy. And so that's a not your typical scenario, but a typical enough for this illustration purpose. Let's talk about what exit looks like. So you see from that last slide, in the end, you have a much smaller piece of the pie, but that pie is a lot more valuable, right? We started out at zero, and in our illustration, you've got a $1 billion pie at the end, and you own a small piece of the $1 billion pie, and it was worth all the effort and all the dilution. If you want to calculate what that dilution will look like, this website right here, and I went and I checked it again before doing the presentation. It's a great way to calculate what this will look like for your particular scenario. You can either screenshot that or take a picture or write it down, and use that as you go forward. So your average founder at the exit will typically have 10 to 20%. Which will be good unless you have liquidation preferences. And I know from doing a number of these presentations, since we started to have softer economic times, a lot of entrepreneurs, like younger entrepreneurs that are starting out doing this for the first time, they don't know about liquidation preferences because we haven't seen them in a while. But I've been around for a long time, so I've seen them. And Anthony, certainly you've seen them, and you can advise your clients as to what liquidation preferences look like. But let me just give you a scenario so those of you who don't know what it is. So if an investor comes in and invests $10 million in your company, just for round number purposes, and they have a 1x liquidation preference, what that means is that they will get their $10 million back before you see penny one. And there's a lot of more complicated scenarios that your advisors can help you with, but that's essentially how it works. And so those liquidation preferences over multiple rounds can stack up and become onerous. And I've actually known entrepreneurs, I'm thinking of one in particular, who raised a bunch of money, executed well, sold his company, and on paper it looked great. And I said, "Were you in the money?" And he said, "No, the liquidation preferences killed me, and I didn't make anything." So could you imagine running a company for 9 years, putting your heart and soul into it, only to sell it and just make money for your investors, and you walking away with nothing? That's not a good scenario. So I I, as a founder, would be more concerned about liquidation preferences than I would about valuations, and certainly get smart lawyers around to help you through that process. And then the investors, look, they typically will have 55 to 60% of the company, but if you're having a nice exit like the one in our scenario, you're happy to give it up because you couldn't have gotten there without them. So to conclude, we've talked about the financial model, various types of capital at the stages, how much to raise and when, dilution exits, and I usually a presentation like this generates a lot of questions, and so I leave time for those questions. And I will stop my screen share and let you ask if you have them.
Great, thank you so much, Carl. So for questions, what we can do is if you can just type your questions into the chat room and I will read the questions to Carl and so everyone can clearly hear them. So, and we'll if anyone has any questions they want to start with, you can just start putting it in. And Carl, thank you so much for that tremendously informative presentation. I know as an entrepreneur as well, you covered things that are key and really on people's minds.
So sorry about the slide screw up there, guys, but that's what you got to do when you're making an investor presentation. If you get on and your slides screw up and mine froze, the investors are watching to see how you react under pressure, right? And so I've got 30 people watching me and I'm like, oh crap, the one time my slides don't work, and so I could either freeze and look like an uninvestable entrepreneur, or I could just drive on and do what's going to work, and that's what I did. And so that's a good lesson learned for all you guys who are going to be pitching for money. Let's see, there was a question up here about hardware and green tech, and so look, with hardware, you can get hardware companies funded. It's more challenging, right? Because most of the funds out there, and it drives me crazy because I help companies of all types raise money, and some of these hardware plays or where hardware is a component, they're really good companies, but then the VCs will come back, we don't do hardware, right? They all like that SaaS predictive recurring revenue model. Mike, I love your baby in the screen there. That's really cute. So anyways, I knew Mike when he was a single guy. So that's wonderful to see. So you need to get with advisors who understand what funds do hardware, and there's ways to sometimes, when the hardware is a component of a service, to really kind of wrap the hardware into a predictable recurring revenue model. And I don't want to just start shooting from the hip here, but I've advised many of company over the years of how to do that. Green tech, once again, you've got to have advisors who understand that space and understand the investors in that space. I was helping a really good green tech startup earlier this year, and the company had 12 million in revenue. It was getting a ton of investor interest, but the challenge was customer concentration. Like, most of their revenue was from one customer, and even with 12 million in revenue, the investors were saying, "Oh, this is really interesting. We love what you're doing, but we want to see at least 3 customers paying." And so the CEO, after hearing that enough times, decided to pause the capital raise after 2 months of getting a ton of interest. And he was smart enough to say, look, we're going to pause this. We're going to go and we're going to diversify our customer base, and then we're going to pick it back up again. And so, that's just one little thought there for green tech startups. So diagram. I'm reading the questions here, but Anthony, if you want to shoot, go ahead.
Yeah, so one of the questions that just came up was from a pre-revenue tech startup that's shortlisted with a high-profile accelerator, and wanted to know how they should be thinking about the structure of the deal, which is 6% equity for $20,000, so $333,000 valuation, and plus an optional $100,000 convertible note with unknown equity, and trying to just understand how they should think about joining accelerators. I know a number of accelerators have different types of models in that range, and would be helpful if you could share with the audience today just the thought process behind that.
Yeah, so look, 20K is not going to go that far. I mean, that's the reality of the situation, right? You're really gonna have to operate lean, and you're gonna have to put that 20K to use in a very smart way, right? And so you can make that 20K go far, but you got to think about it. That's a lot of dilution to take early on. That's why I was harping on the non-dilutive capital, finding those customers who will pay you, because as you can see from this scenario that I'm reading right now, that's expensive capital, right? That's a low valuation, right? And so, um, is it worth it? Is it worth it? If that 20K is going to, give you, I mean, gas money to drive to go visit customers, yeah, I mean, like you really got to make that 20K go far. And so if you need that 20K to get to the customers who are going to pay you, yes. But if you're going to raise 20K and you're not going to be able to monetize that, then 20K for 6%, that's a lot of equity for a little bit of cash. The 100K is more interesting, and as a convertible note, yeah, absolutely. And yeah, we did our raise. I mean, I think we had like a $3 million cap or something, and so that's expensive. Like I did it and I understand, but now that I have revenue in my company, I don't want any more money at those terms. Like people said, you still open for that, not at those valuations, no, and so look and see what the cap is going to be, because that's going to show you whether or not you're taking that 100K is going to be worth it. You could do a lot more with 100K than 20K. And so, you know, yeah, if that 20K will get you to the 100K, yeah, maybe you give up the 6% to get there, and then you've got more to work with. But I would be looking real hard at how to get to revenue, because revenue changes the whole equation. We were pre-revenue, little bit of revenue, and then when we figured out how to get more revenue, then it changed everything. I hope that helps.
Great, thank you. Another question that came in, you talked about non-dilutive funding, particularly for life sciences companies. Would you recommend trying to go with grant writers and non-dilutive funding before approaching VCs for kind of an early stage life science company?
Yeah, in our case, so the grant writer, and I'll give you like real life scenario, right? The grant writer that I was introduced to is strategic. So I think we're paying him a consulting fee of like 35 grand. And that some of that money was money I put into the company. Like we're putting our own personal capital in to hire this guy, and this guy knows angels. He knows the customers. He can help us actually run clinical trials. We're doing a pig trial right now, and you know we're hoping to get data out of that we can use for subsequent money. And so, absolutely. And do your diligence on the grant writer. Like we didn't just talk to this one guy. I talked to a number of these folks, and I know some of these folks, and I think they're worth the money you pay them to get to the folks they can get you to, and get the, look, paying 35 grand for us is a lot better than giving up massive amounts of the company to somebody at this stage. Like, because our value is really close to zero. The further we get along, it's going to be more valuable. If we do that trial on the pig and we get the results that we want, that's gonna increase our value. So I think it's worth it. I've advised others to do it, and I'm doing it myself.
Great,
And
thank you,
what's
Carl. The next
okay.
question is really around the concept of how much money to raise before product market fit. And our viewer today had raised $500,000 in a friends and family round on a safe, and is trying to decide the downside of raising another 500,000 on a second safe before hitting product market fit versus jumping straight into a larger round now, but with more dilution. So, that whole decision point of how much to raise between rounds.
you know Over the 25 years I've been doing this, I've seen some super expensive product market fit exercises. You could literally, you know POA tens of millions of dollars trying to get to that product market fit. If you can get there on hundreds of thousands of dollars, like what you're doing, if you're not there yet, I mean, it's great that you know that you're not there yet. So the capital raise product that we have, Anthony's familiar with the first version of it. We didn't really hit the product market fit. We went out and we thought we had, but when we got it into the market, you don't really know that you got product market fit until you're in the market with it, right? I mean, you've got to have it out there. You got to have people using it, even if it's just pilots, right? I mean, in our case, they were paid pilots, and the idea was we were selling to service providers, and we thought, because the platform I developed was valuable to me as a business development person in a professional services organization, I thought it was going to be valuable to everybody else. Well, honestly, not everybody behaves like me. I used to make investor intros. We sell into Silicon Valley Bank, and there's like a handful of bankers over there that are all over the product. They love it. Or TriNet, they're all over it. A handful of them, right? But that's not a business, right? Like, you got to get to like 300 people in an organization, to have a decent license revenue, and we weren't getting there. We were getting to like 30 people, and we're like, well, I thought this had a product market fit, but it doesn't really. And so we realized that the real pain point in what we were trying to solve was with the entrepreneurs. And so we had to really figure out, all right, how do we package this in a way that we can make money off of it, with where the real pain point in the equation is. And we've done that. I think we have product market fit, but I'm going to tell you, we're still experimenting with this. And so, we raised 150,000 to get there. If you can get there, raising a little bit more money, yeah, do it. I would do it before you get to the A round. No A round is going to really, not any investors that's worth his or her salt is going to want to come in before you've gotten product market fit. So I would try to get there as quick as you can with as little money as possible, if that helps, Mario.
Great. Thank you, Carl. The next question, Rachel asked if she could just ask the question directly. So Rachel, go ahead.
Hi there. Thank you so much for your talk. Rachel Zayas, CEO of Age Diagnostics. My team is developing a blood test for fatty liver disease. So I think that this question is pertinent to a few others on the call. So we're a life science company, so we've gotten a few grants, we've gotten pre-seed, and now we're raising a large seed, Series A, and we're trying to close this round, but it's really how do we best source new leads? Because we're at this interesting point where we're between angel networks and VCs. So how do you recommend we best identify and get in front of new individuals?
Yes, you're the one face I could see when I was doing the presentation for some reason. So I appreciate you're very engaged, and you kept me going through my slide snafu. Yeah, I see a lot of companies through this stage. You're kind of in that valley of death. I know exactly where you are, and so hopefully you haven't exhausted your service providers. I mean, if you're working with Next, Shulman Rogers, certainly they have contacts. Hopefully you're working with an accounting firm, or you've aligned yourself with an accounting firm that has those contacts. If you're banking with SVB or one of the venture banks, they have those contacts. Certainly sit down with your providers and work with them. If you have advisors, so for example, when we formed our board and advisory board for the life sciences company, we surrounded ourselves with folks that had been out there and done this before, and certainly you can lean on them, and sometimes they'll even put money in, right? I mean, that's the scenario that we experienced. If I would go to the free sources first, right? Certainly. We do have the platform that we built as well. When you build a profile on capitalraise.net, you can't see it, but I can see who matches in our database, and we're building towards a 10,000 investor database on there, and personally getting to know all of those investors that we don't know. I can look and do a Zoom with you and show you who in our network is a fit, right? And then you can assess, like, if there's just 20 20 20 that are a fit, you know, I'll tell you today, in full disclosure, it takes a lot more than 20. It used to be back in the good times, I could reach out to a dozen VCs and get you funded if you were fundable, but that dozen has turned into like 200 plus. And we've got a company we're working with that's getting a term sheet this week, and I can tell you we reached out to over 200 investors.
Wow.
Yeah, yeah,
Wow.
it's a lot of work. We're earning the little fees that we get for doing this because we're working our butts off. And not only do we reach out to 200, we're following up with the ones that didn't get back to us, and you know, it's a lot of work. And so
Yeah.
you've gotta. I don't think any of your service providers are going to do 200 emails for you. So you gotta. That's where you've got to decide. You know, do you need? Are we at the stage where we need to amplify this effort? And if you are, you know, you can look at our platform. There's other platforms out there. I think the differentiator with ours is that we actually have, they're actually warm referrals, right? We actually know these people we're sending to. So
Yeah.
it's something to look at. But
Well,
certainly offer all, you know, exhaust your free resources first. But your law firm's only going to do so many. I know because I work for a law firm, and as much as I loved the clients we work with, you know, I'm only going to send so many of these things out, right? Like, you're not paying us for this, right? And so that's just reality.
excellent.
Great.
Thank you. I would love to follow up offline. I have lots more questions if
Yeah,
that would.
sure. Sure.
Thank
Anthony knows how to get me. I can put my
So
email in. I'll put it in here so you guys have it. Any more questions?
yeah, the next question is around, you talked about strategic investment. So Mario had a question around, he's engaged with a company that's 500 million in revenue, and they're newly looking at startups for long-term diversification. And we're seeing a broader trend in corporates looking at startups for innovation. And he's gotten some no-string funding from them, and so they're interested, but he was explaining they're both new at it. He's new at working with larger strategics, and they're new at working with startups. And so there's some bumps in the road, and he was just wondering if you could just shed some light on ways to work with strategics.
Well, that's, you know, once again, it's sorry to make this a commercial for Shulman Rogers, but you want to have a good lawyer helping you through this, right? You know, the money you spend having somebody who knows what they're doing help you through this is going to be worth its weight in gold, right? And so if they have corporate attorneys that don't deal in this type of stuff, it's going to be hard to structure this in the way you need it structured. And then there's also some gotchas, right? Like if they want to write a first refusal on an exit, you know, I would get that out of there, right? Because that $500 million company is not going to be able to give you the exit that, you know, a multi-billion-dollar company would be able to give you. And so you've got to always be thinking towards, you know, at the end game, right? And so yeah, that money looks interesting now, but don't cut off your nose, you know, to get it, right? Like you don't want to do that. And so those are the two big things that I would recommend.
Great, thank you, Carl. The next question we have has got to do with friends and family investors. So early on in your chart, you kind of laid out that one of the strong places and common places people go is to friends and family. As you go into later rounds, particularly if you've added a large number of friends and family, do you see kind of consolidation or buyouts of some of those early investors as you move into later rounds, or do they kind of continue to go along with the cap as part of the capital stack? And what do you do with friends and family if the later round investors want to kind of simplify the cap table, if you have any holdouts?
Yeah, so it's a good idea to lump those you know, friends and family investors into an SPV, a special purpose vehicle. That way you've got one one entity on your cap table, not 100. You know, there's, I don't know what the number is today, Anthony, but there's a number that you're technically a publicly traded company if you get too many investors, right? And so I've actually seen companies that were technically publicly traded companies because the number of people on their cap table. So having that organized into an SPV, special purpose vehicle, is a wise thing to do. And certainly when you're taking friends and family money, you really got to think about their capacity to invest, right? If this person is going to be, writing you a $5,000 check and they're going to hound you every week about, their $5,000, it's that $5,000 in the longer scheme of things is not going to be worth it. And so some companies will have a minimum amount that they'll take. And then they'll also want to make sure that you're an accredited investor, right? Like that you've got, what is the definition now, Anthony? Is it $1 million or more in liquid net worth? Yeah.
Yes.
So you really don't want to be taking your father-in-law's money who's investing it out of his 401k or IRA, and they need that money. That's not a comfortable situation to be in. And so yes, you will want to try to get them off the cap table early if they want, right? Because this is gonna be a 10-year slog, and you've got somebody's capital who really needs that capital, and you have the option to give them an out, you certainly want to do that. I've actually had that conversation with one of my investors because we were flush with cash, and I gave him the option of getting out early, right, with some interest, and he didn't really need the money. He thought, yeah, maybe I'll reassess, but we haven't really had that conversation. But it's something I would do, right? Because I actually don't need his capital anymore. He may want to stay in now. So it's an option that you can give them, but you don't want to promise that to them up front. You want to let them know that this is a risky investment. You've got to be honest with them, right? Especially when you're taking friends and family. There's nothing worse than losing friends' money, right? If you haven't done it before, let me tell you, it sucks, right? I did a bank startup in 2007. I could not have foreseen that 2008, like Bear Stearns was going to go down in the middle of our capital raise. But you live through that, and you take your friends $50,000, and then you lose yours along with theirs. It's even more painful to lose your friends' money. And so you've got to let them know this is a risky investment. There's probably safer things you can do with your money. I appreciate that you trust me with this, but have the conversation with them, right? And the other challenge with friends and family is a lot of times they're not sophisticated investors. And so if you come to them with a convertible note or a safe note, they'll be like, what? You'll have to educate them as to what that is and what the benefits are of getting into that type of vehicle. But sometimes they want a stock certificate, and you got to deal with that, right? And so those of you who raise friends and family money, you've had this conversation. There's some education that has to go on there if you want to get them into a vehicle that's going to be more attractive for you.
Great. So Carl, we're coming towards the end of the presentation. I wanted to just see if there's any final parting thought for many of the entrepreneurs who are on the call with us today.
Anything for anybody? I hope this was helpful.
Any other questions for anybody? Okay, so for people who are interested in the deck, if you just we have posted in info@next.law. I've just posted it in the chat, and we will make sure we get that distributed to you. And on behalf of everybody here today and Next, powered by Shulman Rogers, we want to thank Carl for joining us today. This was a tremendously, as I said, insightful presentation with so much actionable and useful information for our listeners today, and we really appreciate it. And we'll also be posting this so that with some of the information that you maybe couldn't take it all down in one shot, you'll be able to watch it and be able to listen to it again. So with that, I want to thank Carl. Thank you so much for joining us. And
my pleasure.
And again, to thank all of the listeners who joined us today.
All right, thank you.
Thank you. Have a good afternoon.
You too, Rachel. Take care. Bye-bye.